Here are three major differences between a first lien HELOC and a traditional line of credit. A traditional line of credit is typically in second position behind your existing mortgage. Most of you bought a home using a traditional 30-year fixed, you've built up some equity, and when you talk to a lender, they will give you a second mortgage, which is your home equity line of credit. The strategy that we teach is a first position home equity line of credit. So you can either use the strategy to purchase your home upfront, or for those of you that already own a house, we'd be refinancing to pay off the existing mortgage, and then the HELOC takes over that position, hence the name First Lien HELOC, because we're in first position, and that becomes your mortgage going forward. The second major difference is the draw period. On a traditional line of credit, you typically get 3 to maybe 10 years that the bank will give you access as what they call a draw period on your line of credit. So during your draw period, you can pay down your line, you can run it up, you can do whatever you want. You have access to that line of credit within that time frame. If there's a balance that's owed, you have an interest-only payment that you have to make back to the bank. Once the draw period expires, you can no longer access your funds, and you now have to pay off whatever balance is owed on the line of credit if there is one. Here's the catch. Your payment now goes from an interest-only payment to a principal and interest payment that's then amortized typically over 20 years. The issue for a lot of you, if you did that, is you need to make sure you pay down or get your balance as low as possible before the draw period expires. Because if you still owe $100,000, $200,000 on this line of credit and you haven't paid anything down, you're going to get a rude awakening when your draw period expires. With the first lien HELOC, it's a 30-year draw. You have access to that line of credit for 30 years, so you don't have to worry about this shorter window of time that you have access to either invest or you have access to your money. You have access for 30 years. And last but not least, the way I look at a second HELOC on a traditional mortgage, you're adding debt to your overall profile. Most people are not going to pay off the existing HELOC that they have within that draw period. And this is where a lot of lenders will get you, is that once that draw period expires, they're going to then come back to you and ask you if you want to refinance your mortgage, your first and second, back into a 30-year loan again, because it's going to lower your overall payments in most cases. And for those of you that have racked up debt with credit cards and you've racked up debt on your HELOC, you're going to look for a way out, and it's going to be a very painful thing because you can either suck it up and have 2 mortgage payments on your house, or you're going to refinance into 1 mortgage and start this 30-year process all over again. With the 30-year HELOC, we're talking debt elimination. Most of our clients will pay off a mortgage within 3 to 7 years. It's that fast. So when you hear HELOC, don't automatically assume it's a second mortgage, because there are first lien HELOCs that we teach that are available.